Hi, I'm Patu from freefincal, and in this video, let's take a look at the Nifty Valuation Tool I had released today. This can help us find out if the market is expensive or cheap, overheated or undervalued. This is an Excel sheet, and this is based on an earlier version I had released, but I've changed many things in the Excel sheet, added new features. This before you begin, we begin. This is not free, but it's the sheet is priced at ₹1,000, but because this is the 7th anniversary for freefincal, I had you can now get it for 500 for a short period. So the link is in the description box for purchasing the sheet. So what is the idea behind the sheet? The idea behind the sheet is to take an index like the Nifty, the Sensex, Nifty 100, or you can choose any other index you like, and find out what is the level of the market, what is the current state of the market, how is it overvalued or undervalued. That is in the sense that if the stocks are worth only that much and if the current prices are that much, the market is overvalued, and if it's the other way around, it's undervalued. So you can actually find out, and so this can be used for tactical asset allocation when you should move out of equity and when you can re-enter back into equity. Ideally, some people will invariably use it for dip investing, find out when to add more and when not to invest and so on. You can use it, although the biggest benefit would be to tactically asset allocate, book profits and re-enter periodically. So there are several valuation tools. I have the post I wrote today as a reference here. I don't want to make mistakes in what I say because many of these things I keep forgetting the definitions and so on. So I will be looking at this screen from time to time, so excuse me. So this is the instruction sheet. So you'll have to first enter a name of an index. This is only for your reference, and then you will have to choose the moving average for the for finding out the long-term moving average of the price to earnings, price to book, and the dividend yield. Usually it's 10 years, so you can choose 3650 days. There's no need for you to change this. Then there is we have moving average indicators. That is, we take the last 180 days or the last 6 months average or average of the price, or we take the last 365 days of the price and calculate the moving average to reduce the noise in the daily movement of the index to find out the trend better. So that's steps 3 and 4 that you see here. When you then you'll have to actually go to the niftyindices.com, or you can go to the BSE website, get the data and paste it here. The automated option does not work anymore. It's no longer feasible. There are too many problems with it, so I decided to remove it. And also I cannot be offering that in a paid tool and so on. So whatever terms and conditions of those websites, you are bound by them when you use the sheet, and you'll have to copy and paste the data from there onto the sheet. It will just take about a minute, not more than that. So once you get those data inside into the sheet, the instructions are very clear. I don't want to waste the video on how to do it and so on. It's very simple. Anybody can do it. Once you paste the data onto the benchmark sheet and the data sheet, you'll have to come back and check on steps 3 and 4. Find out if this indicator here says good to go, good to go. If it's good to go, you're okay. For example, sometimes, let's say you have pasted a new index, and let's say this is 187, for example. I've changed the interval over which the average is calculated. It's a big sheet. It will take a bit of time. So notice that when I changed it to 187, it says increase or decrease by 1 or 2 days until you are good to go. So I will have to move it back. I'll have to change this, so I'll make it back to 188 and wait for it to. Yeah, there you go. That's good to go again. So wait for it. Then only when it's good to go, you should proceed further and look at all the other calculations. So unless it's good to go, you cannot use it. Then there is something known as the moving average convergence divergence signal, and this is the signal averaging duration. I'll talk about it, and that's set to 136. Don't change it unless you are comfortable with it and you know what you are going to get it. So what's the main aim of this sheet? The main aim is to look at market valuation using different types of indicators. Look at it in terms of price to earnings, look at it in terms of trend, that is the moving averages, look at it in terms of momentum or volatility using the Bollinger Bands, and also something known as the relative strength index. So let's get to it one by one. So the simplest technical indicator is the 6-month, approximately 6-month on the 1-year moving averages. So these are the double moving averages. And what happens here is, you can see here, let me just go back here. So you can see, if you can see this part, the if you can see whenever the 6-month line, the 6-month average line falls below the 1-year average line from from above, it falls. So the 1-year, the 1-year average line, or the 365-day average line is here, and the 6-month line comes from on the top and it just comes down. Then it means it's indicative of a bearish trend. And then the opposite, when the 6-month line from below goes above the 1-year line, it is indicative of a bullish trend, and vice versa. The details are there in the post. I'm just giving you with all the lines and so on. You can see that. So you'll have to look at when these averages cross over. So that's the crossover, average crossover. When they cross over, they are indicating of a bullish or a bearish trend. But the problem with it is, if you look at the recent data, you can see that these two lines will cross over each other in quick succession. That's a kind of a pain. When this happens, you are not sure about the trend. So instead of using a simple moving average, that is calculating the last 180 days average of the price, or the last 365-day average, or 200-day average of the price, we use something known as the exponential moving average. In an exponential moving average, I don't want to get into how it's calculated. There's a link within the article. You can look at that. Only thing is, the exponential average, it reacts better to what can I say? To more, it offers more weight to recent price movements, and it reacts faster than the simple moving average to market upward and downward movements. And the so-called whipsaw, that is the frequent crossing overs, will be lower in this when you use exponential moving average. So you can see that the 188-day average, the 188-day EMA has been well above the 365-day EMI for a long time. So we have been in a fairly bullish market for a long time. And even in the recent trend, you can see that the 188-day line has been well above the 365-day line. So we are in a overvalued market, clearly. So the another indicator is the MACD, or the moving average convergence and divergence. So what they do in the moving average convergence divergence is, first of all, it's a more potentially sensitive method. So they take the difference between the 188-day moving average and a 365-day moving average. They take the difference between the two exponential moving average, and they take the moving average of the difference itself. So so the average of this difference is called the signal. So you have those two averages that you saw before. They take the difference, and then they take the average of the moving average itself. The period of that moving average is 136 that I showed you earlier. And the logic is quite simple. If the MACD falls below the signal, then it's bearish, and if it moves above the signal, it's bullish. So that's I hope I got that right. Let me see. Yeah. So when the MACD goes below the signal, it is a bullish trend. When the MACD goes above the signal, it's a bearish trend. These are long-term technical indicators. They are not the kind of technical indicators which is used for trading and so on. So you'll have to get used to it a little bit from that. So if you look at the current trend here, you can see that again, but unfortunately, there's been a lot of crossing overs, and currently now the MACD is above the signal, and it's again a bullish trend, but there's a lot of frequent crossovers here, so it's not a little bit accurate currently. So that's the problem. So it's You have to be careful. That you have to recognize that it's like a blind set of blind men touching an elephant. Each one will give you a different indicator, so you'll have to take a call on that. The next one is the Bollinger Bands. This is something that I personally like because I'm a fan of volatility, and what they do here is to calculate the 200-day daily moving average as a simple moving average, and they draw what is known as the upper Bollinger Band and the lower Bollinger Band, and that is the upper band is 2 standard deviations above the center line, and the lower one is 2 standard deviations below, and this gives you 2 sets of information. One, it tells you the trend like all the other moving average indicators. The other one is that it also tells you the volatility. When the lower and the upper band start diverging like that, that means the volatility in the market is increasing. And when the price actually shoots, when the volatility is increasing and the price shoots up above the upper band, that means that there's a possibility of a correction. But when the upper and lower bands come together, they converge. That means there's a decrease in volatility. And when the price goes above the upper band, when there is a convergence, then there is a possibility of a upward of a bullish trend. Now, if you look at the recent data, there it is. You can see that the gap in April 2018, the gap between the bands was higher, and then it has now markedly converged in the build up to the election, and you can see that the price is now above the upper band. It could mean an extended movement upwards. We don't know. As of now, this is how it looks like. This can be used for market timing as well as tactical asset allocation, in the sense that whenever you see that there is a divergence and the price moving up, you can book profit from equity and move back to debt. But with a clear understanding that this does not mean you will get higher returns, it's for lowering risk. There's a big difference there. So that's about that. Then there's one more indicator called the Relative Strength Index, and this is abbreviated as RSI. So the relative strength indicator, well, it's a fairly complex calculation. I'm just going to read off. What I wrote. The simplest definition of the RSI is that it represents recent average gains divided by average losses. So if the average gains are higher than the losses, then the index is overbought. If the average losses are higher, then the index is oversold. So essentially, the idea is that the RSI tells you it's a bit like a P in terms of average losses and gains. And if the RSI value is high, that means that the index is the market is overvalued. If it is low, the market is undervalued. The problem is it's very hard to define what is a high RSI and what is a low RSI. You can see the RSI is here in this case. RSI above, typically above 55 RSI, the market has been overvalued, bound for a correction, and 50 and below, it's bound for a movement upwards. Please keep in mind, when I say market is overvalued and it is due for a correction, I do not know the quantum of correction. When I say when the market is expensive, that does not mean it will automatically become cheap. When some indicator says it's expensive, it can correct by 1%, it can correct by 0.5%, it can correct by 10%, 15%, 20%. I don't know. Nobody knows that. That's very important to understand, and I will show you an example of that when we talk about the price to earnings. So that's the RSI is an indicator that's more useful for finding out if you're looking for a time to invest in. Although it's not productive, I have videos on this. If you're finding out for a good time to invest in, then you look for an RSI which is like less than 55 or something like that. Then it's a good time to invest in. It seems like a good time to invest in. There's no need for you to book profit or anything. The RSI is not very high. It's only about 22 or so, something like that. So it can be used as an indicator to buy. This is just a momentum indicator because it tells you about the gains versus losses. So that's that. Now we move on to the price to earnings ratio. This is the Nifty price to earnings ratio. Let me try and make this bigger. Okay, that did not crash. This is a very heavy file. This is like 17 MB or 18 MB file, so you have to be careful. It's got a lot of calculations in it. So the what you see here, this is the Nifty PE, and the central line here is the 10-year average of the Nifty PE. It's a moving average. It keeps going. Notice that it keeps going more or less a little bit up. And this is one standard deviation above the average, two standard deviations above the average, one standard deviation below the average, two standard deviations below the average. When the Nifty PE touches one standard deviation below average, then it's a great signal to buy. There's no doubt about that. And every time the Nifty PE has hit the two standard deviation line, typically it tends to correct. Sometimes it corrects a lot, sometimes it corrects only a little. You can see here this correction has not even touched the one standard deviation line, and it shot back up, went above the two standard deviation line, corrected, touched up the one standard deviation line, and now it shot up again. Now it's again, obviously you know that the Nifty is overvalued, PE is overvalued. So price to earnings essentially means that the price of the stock is higher than the earnings that it offers. So which means that it's like saying a handkerchief which is worth 10 rupees is actually being sold at 100 rupees, which means that the price will correct, right? So that's the logic. This is not mean reversion. Please do not call this mean reversion. This is wrong. We will do a detailed video on what is market efficiency and mean reversions and so on. This is not mean reversion. If something moves up and saying it will come down eventually, it's not mean reversion. There's a lot more to it. So that's price to earnings. There's another ratio called the price to book value. So this price to book value is essentially like it's like saying it's like an ETF, right? In an exchange traded fund, there is a NAV, that is the value of the assets, and the price at which the ETF unit is being sold. So if the price of the ETF unit is being sold more than the NAV, that means that's overvalued. So that's so the price to book value is identical to that kind of an idea. So a high price to book value essentially means the market is overvalued. A low price to book value means it's undervalued. Again, you can see that Nifty PB here. The central line is the 10-year moving average. One standard deviation below, two standard deviations below. It has never gone two standard deviations below. Notice that the price to book value has never also hit two standard deviations above also. It has recently, you can notice that it has corrected even, it has corrected in the past, even when it was average. Even when the price to book value was average, it has corrected. And only once it has touched the one standard deviation line, and notice that the big difference in the one standard deviation line, they're converged quite significantly in the last couple of years. So I'm not sure if the Nifty PB is a very sensitive indicator of market valuation. It could be a very conservative indicator because even for a small change, you might end up making big changes in your portfolio. So I won't take that too seriously. Just to have a quick look, it's okay, but it's difficult to do more just using the Nifty price to book value. Then the other one is the dividend yield. So the dividend yield is, let me try to make this bigger without crashing the file. Try to delete this. Yeah. So the dividend yield is another indicator of valuation. So the dividend yield is essentially the dividend paid divided by the price. So the dividend yield is a contra indicator. So if the price of the stock is very high compared to the kind of dividends it's offering, then the dividend yield will be low. So when the correct. So and when the price of the stock is low and the dividend compared to its dividend, the dividend yield will be high. So the idea is that when the markets are overvalued, the dividend yield will be low because the stock price will be high, and when the market is undervalued, the dividend yield will be high because the price will be what did I say? Let me say it again. Oh my god. So when the market is overvalued, the dividend yield will be low, and when the market is undervalued, the dividend yield will be high. So it's a contra indicator. That's because the dividend yield is, so when it comes to the reason why this is different is because in price to earnings and price to book value, the price is in the numerator. But in the dividend yield, the price is in the denominator. So it's a contraindicator. So when the market is overvalued, dividend yield will be low because the prices are high. And when the market is undervalued, prices are low, then the dividend yield will shoot up. So that's, I hope I didn't confuse you too much. Again, you have the Nifty dividend yield. You can see that this is just before the crash, and when the prices crashed in 2008, look at how quickly the dividend yield moved up, and then when the price recovered again, the dividend yield also became low again. And notice that the dividend yield has been hovering recently one standard deviation below average. So only once it has moved significantly. So there's only been 2 times that it has hit one standard deviations below, and both times it has corrected back up towards the average, and the dividend yield is just about touched the one standard deviation line. So it is again overvalued from this aspect as well. So that's that. 2 more left in this sheet. If you, I don't know how many of you are still watching. Yesterday I talked about, or maybe this is a day before, I don't remember. So I talked about why there is this market the price is high and it doesn't justify because there are no earnings. You can actually calculate the earnings per share growth rate. That is the rate at which the earnings per share is growing, and you can see that in 2002. There was a sudden shoot up in the earnings per share growth because the interest rates plummeted in 2002. The PPF rates dropped down to single digit, if I remember right, around that time. And that time there was a very strong increase in earnings per share growth rate, the growth rate in the earnings per share, and that resulted in the bull run. But after that, the earnings per share growth rate has been very, very low. It was reasonable up to 2015, and then it crashed down again. And it's trying to recover, but again it falls back down. Trying to recover, falls back down. That's the problem. That's why I said there's no real evidence of corporate growth in the earnings per share. That's the reason why I said this market is full of fluff. You can also find out what is known as the book yield or the return on equity. So this is the PB ratio divided by the PE ratio. Let me try and make this bigger. So the PB divided by the PE gives you the earnings per share divided by the book value. So this is like the return on equity. So this is a rough measure of the return on equity, and the return on equity has been falling down consistently since 2008, and that's very scary for me. I don't know why. I mean, I don't know how long the prices can keep going and the return on equity can keep heading south. So that is the reason why I keep saying there's really no evidence of a data-driven movement in the stock prices. It's more of euphoria, more of hope, of money flowing in from different directions. Sometimes the music may stop playing, and you have to be very, very careful and be alert in case there is a crash. So that has been a long video about the Nifty Valuation Tool. If you're interested, download the tool from the InstaMojo link given below. The description of all these are given in the post. I apologize if I have confused you in anything. These things are difficult to get a handle on. You need to practice it, get used to it, and so on. So let me know if you have any questions. I'll catch you again in another video. Bye-bye.